Assalamualikum OyaRahmatullahe OyaBarakatuhu. Welcome to my virtual classroom, MKA Classroom. Now let's start today's video tutorial. Capital structure theory. Capital structure theory, this is our today's topic. Actually, capital structure theory deals with the relationship between a company's capital structure and its total market value. So we will see that this capital structure theory actually related to the total market value of the share of the company. Total market value of the company. We assume that maximizing a company's total market value is consistent with maximizing the market value of its ordinary share. We assume that the maximizing a company's total market value is consistent with the maximizing the market value of its ordinary share. Traditionally, it has been assumed that there is an optimal capital structure for a company. Optimal capital structure of a company. Optimal capital structure is that ratio of debt and equity that maximizes the firm's total market value and minimizes its cost of capital. So there has the optimal capital structure theory. Optimal capital structure. Optimal capital structure actually is that point. It shows the ratio of debt and equity. Debt and equity, or equity and debt, in a way that maximize the total firm value, maximize total firm value and minimize its cost of capital. So optimal capital structure is that ratio of debt and equity which shows maximize the firm value and minimize its cost of capital. Actually, is there any optimal capital structure? Is there any optimal capital structure? There are three views on these important questions have been proposed and debated. So here we will see traditional view, view with no tax, and view with tax. So is there any optimal capital structure? To answer this question, there are three views which are proposed and debated. That means we have three capital structure theory. One is traditional view, another is view with no tax, after that the view with income tax or tax. Traditional view. Capital structure theory. Is there any optimal capital structure? So we are trying to find out that answer with the point of traditional view. That means the theory of capital structure is traditional view. The traditional view asserts that there is a debt equity ratio that minimizes the weighted average cost of capital and maximizes the total market value of the company. So traditional view tells us that debt equity ratio in such a way that will minimizes the cost of capital or weighted average cost of capital and increases the total market value or maximizes the total market value. For the changes of capital structure, the company's cost of capital and market value may be changed. So in the above, in the diagram, we are seeing that K naught is the weighted average cost of capital of KE and KD. That means cost of equity and cost of debt. Cost of debt are fixed, that's why it is a straight line. And K naught is the weighted average of cost of equity and cost of debt. For using debt capital by the company, expected or required rate of return of shareholders increases because the use of borrowed funds by a company exposes the possibility of increased variability in their earnings stream of financial risks. We know it that if the company uses the debt capital, then the shareholders also increases its return, the required rate of return, because company experiences the variability of its return or financial risks. The increase in the required rate of return on debt or equity capital is not sufficient to outweigh the reducing the cost of capital from using cheaper debt funds. So here it is clear that if you use the cheaper debt capital, but that also the increase the required rate of return on equity, therefore the weighted cost of capital declines. However, beyond some point, the cost of equity increases in an increased rate such an extent that it is more than offsets the reduction in cost of capital from using cheaper debt. This will cause the weighted average cost of capital increases. Beyond some point, cost of debt may be increases, and this reinforces the increase in the weighted average cost of capital. So called the optimal capital structure. The optimal capital structure is in this point, in X point, where the weighted average cost of capital is minimum and the market value of the firm is maximum. So here is the point where cost of capital is minimum and the firm value is maximum. So in this point has actually the optimal capital structure. and we will see an example to understand this phenomena well. We will try to discuss with example now. Example: assume that ABC company has an all equity capital structure comprising 1 lakh shares issued at 50 cents each. It is expected to earn a constant annual net operating income of 10,000, which is to be distributed as dividend. The rate of return required for the company's shareholders is 13%, and we shall assume for the present that there is no taxes. These are the capital structure: 100% equity capital. Here is 100% equity capital, all equity capital. So here is said all equity capital structure comprising 1 lakh shares and 50 cents each, and net operating income, annual constant net operating income 10,000, which is distributed as a dividend to the shareholders. And this company's shareholders required rate of return is 13%, and we assume there is no taxes. Then what will be the value of the company? What will be the value of this company? We have to find out the value of this company. From the example, we have seen that net operating income is 10,000, which will be distributed to the as a dividend to the shareholders. So this company is all equity farm company, that means all equity, so it has no debt. So what will now income available to shareholders? So if we see net operating income minus interest on debt, so income available to the shareholders is also here is 10,000, and cost of equity capital, here we have 13%, that means 0.13 is our cost of equity. So what will happen to our market value of shares? So equal to income available to shareholders divided by cost of equity. So 76,923 taka is our market value of shares. Market value of debt 0, because here has this company is equity farm company. Then what will happen to our market value of this company? Total market value of this company equal to market value of shares plus market value of debt. So 76,923 is the total market value of this company. So these are the total market value of this company. So in this case, because there is no debt in this capital structure, so the weighted average cost of capital K is equal to K is equal to cost of equity KE into market value of share E divided by total market value. Total market value. So cost of weighted average cost of capital K equal to KE into value of market value of shares divided by total market value. So here we will try to see weighted average cost of capital, cost of equity, so equal to cost of equity into market value of shares divided by total market value. Then our weighted average cost of capital is 13% because here has no debt in this capital structure. Now assume that rather than issuing 1 lakh shares at 50 cents each, the company has raised the same amount by issuing 60,000 shares at 50 cents and 20,000 of 8% debenture. It is also assumed that the market value of debt remains equal to its issue price and that the company's shares holder now required rate of return of 14% on their investment. The fact that this rate of return exceeds the required when the company was financed solely by equity reflects the additional risks faced by the ordinary shareholders because the company use of debt. So we know that in the previously we have seen that the company has 1 lakh shares at 50 cents, that means 50,000 taka, that was 50,000 taka, $50,000, $50,000. But in here the company raised the same amount, 60,000 at 50 cents, that means 30,000 its equity capital and 20,000 as its debt. This 50,000 is it capital. But here required rate of return increase to 14%. In previously as the 13%, now it is 14% because the ordinary shareholders faced risks by the company's issue of debt. That's why the required rate of return is increases. So we see that it assumes that the market value of debt remains equal to its issue price and that the company's shareholders now required rate of return is of 14%. it increases, record rate of return increases by the use of debt. Now we will see net operating income 10,000 minus interest on debt. So we know that 20,000 our debt and 8% interest rate, that is the 20,000 into 8%, that means 0.08, that is our interest on debt. So income available to shareholders are equal to net operating income minus interest, so 8,400. So we know that cost of equity capital is 14%, 0.14. So market value of shares are 60,000. That means income available to shareholders divided by cost of equity 14%. Then market value of shares are 60,000, and here we assume that the market value of debt will remain same at the issuance. So our debt is 20,000, that is the 20,000. So our total market value now is 80,000. So that is increases. In previously we have total market value is 76,923 taka, but now our market value increases to 80,000, that is increases the market value. Now we will try to see the market price of our share. What will be our market price in these cases? That means here we use debt, here we will use equity. So what will be the market price of our share? So market value of shares divided by market value of shares. So in this case we have outstanding shares are 60,000. We know that from our example, outstanding share is 60,000 and market value of share is also 60,000. So then the share price should be the 60,000 divided by 60,000. That means $1 is our share price. But whereas previously in our previous examples we have seen that the market value of shares are 76,923 and our available shares was 1 lakh. 1 lakh was our available shares. So what will be our share price? Share price should be 76,000 divided by 1 lakh. 1 lakh. 1 lakh. that means it should be 77 cents. 77 cents. So in our previous example, here is the previous example, so where our issuing share was 1 lakh issuing share. Market value of share is 76,000. So 76,923 divided by 1 lakh, it should be near about 77 cents for our share price. Now we have to see the weighted average cost of capital. What is the positions of weighted average cost of capital? So in our previous examples, we have seen that where has not date, weighted average cost of capital K equal to KE into, that means the cost of equity divided by value of shares divided by total value of the firm. Here we will introduce debt, cost of debt, that means plus KD, cost of debt. So here has no tax, we have assumed that 1 minus tax, TE, tax rate, into value of debt divided by total value of the firm. These would be our weighted average cost of capital. So from our examples we will see our cost of equity, that means 14%, cost of equity 14%, that is our cost of equity, divided by into market value of shares 60,000 divided by total market value 80,000 bracket close, plus our KD, cost of debt. So our cost of debt is 8%, 0.08, into 1 minus 0, that means we have no tax, then into we have market value of debt 20,000 divided by market value of total market value is 80,000, then close, then press enter. That is shows the result is 0.125. that is our weighted average cost of capital is 0.125. in previously we have weighted average cost of capital is 13%. This is our previously our weighted average cost of capital, but now our cost of capital reduces to 0.125, that means 12.5%. So we know that the optimal capital structure is such kind of ratio which will increase the farm value. So in this case, our increase the farm value and reduces the cost of capital. So we know that the matter. The weighted average cost of capital has decreased, therefore, from 13% to 12.5%. Although this example is simplified, the logic is representative of traditional view. The example implies that a company is able to increase its total market value and decrease its weighted average cost of capital by the use of moderate amounts of debt. Moderate amounts of debt. In this case, the benefit derived by the company as a result of issuing cheaper debt is not entirely offset by shareholders increasing their required rate of return. Okay. 2. Compensate them for the additional risks. The question remains, will this process continue forever? According to the traditional view, the answer is no. This is shown in the following example. So we have to test these methods again to understand the traditional method more. So still now at first we have tested very fully equally capital structure. After that we tested that 20,000 debt in the capital structure, and then now we will test it that 25,000 debt on its capital structure. Then we will test this matter, what will happen to our optimal capital structure. And now assume that the company had invested that the amount required by the issuing 25,000 of 8% debenture and only 50 cents is, and it issue 50,000 shares. It issues 50,000 shares with the 50 cents. That means 25,000 is it equity capital, and another 50,000 comes from debt. So in this capital structure we see that 50% equity capital and 50% debt capital. Now what will happen? We will see what will happen to the firm's value, where required rate of return is 25,000. Now we will see the example that net operating income 10,000, interest on debt should be changed because now it is issuing $25,000 as a debt into interest rate is 0.08. so interest on debt is 20,000. so income available to the shareholders are 8,000. Now cost of equity capital is changed to 0.25%. so what will happen? Our market value of shares is 32,000 and market value of debt is 25,000. Then our total market value becomes 57,000. So here we are seeing that the debt equity ratio, in the previous examples we seen that 20,000 debt 60/40 debt ratio, and now we are seeing that 50/50 debt ratio. As a result, the market value of this firm is decreases to 57,000. Now if we see the market price of this share is now 32,000 divided by 50,000 shares outstanding. So here we are seeing that 50,000 shares are outstanding. In previously we have seen that 60,000 share outstanding, and before that 1 lakh share outstanding. Now it is issuing 50,000 shares at 50 cents. So that is the 32,000 divided by 32,000 divided by 50,000. Then our market value of the share price is 64 cents. 64 cents. So whereas it is previously cases the share price was at $1, now it is 64 cents. Also the if we calculate the weighted average cost of capital, it also should be the changes. So in the previous cases, the also the changes our weighted average cost of capital increases to 0.175, that means 17.5%. So in this case we have seen that whenever the company uses the 50% debt and 50% equity, at that time decreases its market value and increases its cost of capital. That means it is not actually the optimal capital structure. We know that optimal capital structure is such a ratio which will increase the firm value and decrease the weighted average cost of capital. So in this case issuing 25,000 of debenture has led to an increases the company's cost of capital K and decrease the total market value. This indicates that proportion of debt in the capital structure is beyond the optimal level. So in this way we try to show the traditional view, whereas the appropriate ratio of debt and equity which will increase the firm value and decrease its cost of capital. So finally, at a nutshell, we will see in the first case we have seen that the company has the totally equity financing 1 lakh shares with the 50 cents, that means 50,000 at its capital, 50,000 as its capital. Then the firm value is 76,923, and whereas the cost of capital is 13%. But this firm, whenever issues instead of 1 lakh shares, it issues 60,000 shares with the 50 cents over 50 cents and 20,000 of debenture as debt. Then increases the required rate of return. Then the firm value increases to 80,000 and reduces its cost of weighted average cost of capital is 12.5%. And again we will see the firm uses its date is 25,000 and issues 50,000 shares 50,000 shares 50,000 shares at 50 cents is, then shareholders required rate of return increases to 25,000. Then we are seeing that farm value decreases to 57,000 and cost of capital increases to 17.5%. So in this way, finally we have seen that we have to talk that the traditional view advised a moderate portion of debt should have in its capital structure. That means moderate amount of debt will increase the firm value and reduces its cost of capital.
This all about today. Stay home, stay safe. Assalamualaikum warahmatullahi wabarakatuhu.